Hello everyone, I'm Trace by Ibra. Welcome back to the Quiet Trader series. This is playlist 2 and this is episode 5. As I said, they are going to be continuous episode in the introduction of playlist 1. So this is episode 5, part 1. Episode 5 is going to have 2 parts since it has a lot to talk about. So let us see what we are going to have in playlist 2. Then we continue to the episode 5, part 1. So we're going to see these topics. That's going to be market structure, institutional order flow, and liquidity. So those are the topics that we're going to have in this playlist 2. So with episode 5, part 1, we're going to start with market structure. We're going to have lessons on charts. We're going to have examples with charts. Then in part 2 of episode 5, we're going to have break of structure. We're going to understand break in structure, then market structure shift. Then we shall see the truth about structure mistakes. Then in episode 6, we are going to see liquidity and PDRs and the use of them. We are also going to see charts, or we are going to have some charts there. Then we shall go to episode 7, where we shall find narrative, something to do with bias, liquidity, then execution. Okay, with that said, let us go to the part 1 of this episode 5. So we're going to start with market structure. Then we shall go to the institutional order flow. So the market moves in a structure algorithm. It moves creating highs and lows. That's the baseline and the starting line to the advanced structure. Okay. Sorry. Now the question could be, what is advanced structure? Like the question you could ask yourself, what is advanced structure? Advanced structure is institutional order flow. I think I just answered that recently. So let us start with the basic foundation of price structure. The basic is highs, lows, higher lows, lower highs, lower lows. That is the basic foundation of price structure. But institutional order flow. So let us start with a bullish structure here. Let us be fast. So okay, here I will say we all know in episode 3, we all know how this candle forms. So if you have opened, create a low, runs, create a high, then closes. So the next candle, we don't only wanna watch one candle on lower time frame. That's the like tugenda kubanga to trading a candle. So tulina okumanya candles forming a structure because you trade the structure. How do we anticipate the next candle formation? How do you anticipate the market is going to run to this candle? So you must understand the order flow, the structure we're moving for you to understand that this market is bullish or is going to be bearish. So you're going to need more candles to understand that. So with that said, this candle opens, creates a low, runs, creates a high, it closes there. So if this low is higher than this low, so this becomes a higher low, right? Because it is higher than the first low. Now if this high is higher than the previous high, that becomes a higher high, right? So this is a bullish structure. We want to see higher highs created and violated, right? Violation, I mean price nesigalange moving out to the upside. So with the bearish structure here, let me also be fast onto that because you already know what happens on the open, high, everything. So we have the open, high, low, close. That's how the candle forms. We know that. So the next candle is going to open, create a high, drops, create a low, closes through. So that's a low. So if this high is lower than the first high, this becomes a lower high because it is lower than the first high, right? So that's a bearish structure. So this low is lower than the first low, it becomes a lower low because it's lower than the first low. So when we are in a bearish program, or when we are in a sell program, we want to see lower lows created and being violated. We don't want to see lower highs being taken. So that means there is something. either the market is reversing or it's not gonna work into the way you anticipated price to do. So with that said, okay, let's move to the next slide in here. So let us have something structural, like as a diagram. So price moves higher or rallies, creates a low, creates a high, just as the candles that will have. Now this is something that is gonna, that's like chikina kwa structure tugambe tulina wano candle nyingi, right? Tetulina candle, but we're gonna see that because the market is not moving into one candle on lower time frames, they're moving on candle, so a moving on structure is gonna create some series of candles within. So okay, without confusion, let's stick with me to create a low and a high. So price comes back into that range, then it rallies. This low is lower than that low, so that becomes a higher low. So when it comes back into that range, it has created what? A higher high, right? So that is structural. So market is gonna do the same thing. It's gonna break that higher high, comes back into what? That range, then creates a high. It moves higher, or it rallies higher. So the break is a higher low. So that is a bullish structure. If you are bullish, you wanna see higher highs created and they are being violated. So okay, market is going in a higher time frame. Hitting for us to get a smart money reversal, like for it to start to go into a sell program or to start to be bearish. It trades back into that range, drops lower. So what can we call this? We are gonna see that in institutional order flow, so don't worry. Also we have here that, what can we call that? Okay, for the meantime, to GT high, to GT low. So in a very full stage, a very full say lower high, because this is really basic foundation of price structure. So okay, in a low, in a fuka lower high, because that high, because this high is lower than the first high. Okay, so we have created a low here, price net dropping. So price returning out to this range, jukira in a very low, then in the high. So in a fuka lower low, right? Because it's lower than that low. So price net dumping. So that is a bearish structure. We want to see lower lows being taken out. We don't want to see lower highs being taken out. If it does, then something is wrong with the anticipation that the market is going to be bearish. But with institutional order flow, because this is the basic and this is the foundation of market structure. But for us, we don't just look onto price with higher highs and lower lows. With institutional order flow, we have a different swing formation. We don't have a swing of higher high, lower low. No, we have a different swing formation for us to trust that this is a swing, and this is not just a swing or internal kubera swing. Okay, a swing high is created with 3 candles, right? Let us start with the swing high. Okay, we have got 3 candles. They have been printed on the charts. We are seeing that this high has a lower high and a lower high there. So this is a higher high, not like this, but with these 3 candles. This high is low. This high is higher than 2 candles as a GDM mabbali. So even if this candle made relatively equal highs, I'm not trusting this as a swing high. No, but even if it would have came really close to that, I still validate this as a swing high. So the wicks tichimatalinga, so long as that high it hasn't been taken out or it hasn't been relatively equal. All right, that's a swing high for us. It is created with 3 candles, regardless on any time frame joboliko. So it is a swing high on that time frame joboliko. Wogenda wansenge ina candle zisuka mwezo, it doesn't matter. Okay, for the bearish structure in here, we're going to have a swing low with 3 candles, just like for the bullish one. So this is going to be seen in a bearish structure. When price is moving lower, price is moving downwards. This is a swing low for us. It's not just a lower low, it is a swing low. Now with that said, a swing high or low can also be called a short-term high or a short-term low. because we expect price to create it and it violates it going into the direction that what we're expecting for it to move. Now if we are bullish, we want to see it's going to be created. We want it to stay a short-term high. It is just a short-term high. It's going to be taken out. It's just not going to stay that long. We want to see price creating a GTM. That means price is moving higher. Okay, that said, let us go into more details here. It's going to be advanced. So this is institutional order flow. This understanding the institutional order flow and its structure formation is going to help you understand the idea you're having is underway, or it hasn't, or it has failed, or it's telling you to wait, not yet to engage into price action. So when you understand institutional order flow, the market is going to be communicating to you in a way that you understand that your ideas is underway, or is going to be requiring you more patience. Ngegamba so kolinde muko oba holdinga, like not holding the position, but wait for more price action. You're going to wait for more candles to see if price is really showing that your narrative or your idea is really there into the marketplace. Now, the formation isn't just about higher highs, lower lows formation, but there are more detailed structure we'll be looking at. So tugenda kulaba tuba tunuulidde ki bwe nga tutunuulidde higher highs ne lower lows, because that's not institutional order flow. That is just basic price structure. The following is what builds an institutional structure, right? Okay, that's it. So we have short-term highs, short-term lows that we kutunuulirako recently. Okay, we have intermediate term highs and lows. We're gonna see that. We have long-term highs and long-term lows. So we're gonna see that. An intermittent high or low can become a short-term low depending on structure. We're also gonna see that. By understanding the layers, you stop treating all structure equally. Like now, this can be strongly trusted on time frame, like 1 hour. Now we want to see this on a 1 hour time frame, like to build this structure. Something lower than 15, that means you're going to be looking for entry on sub-minute time frame, right? So yes, the 15 can't hide anything. It's more obvious in terms of showing obvious liquidity, but 1 hour is going to give you more trust. Like to me, even this could be really good if you're looking it on a 4 hour time frame, because 4 hours is gonna be really good. So that said, the minimum it can go with, I think it could be 1 hour minimum. So that is a personal reference. You're gonna do back testing and you're gonna understand that more. So let us get a little bit messy here. Let us say twina old high, twina higher time frame array, or higher time frame, yeah, to GT array. It is there. So nitubane price natandika okujanga trading like that, nigisembererawo katono ne come into that range, ne manage taking it out. All right. So when it is taken out like that, we anticipate smart money reversal. Okay, we anticipate that, but we don't just jump in. We have things that we be looking at, and that those are the things betulabye waneno mu institutional order flow betugenda okubanga tutunuulira, because tutunulira structure market ekoze etya for us to trust that the market has created a smart money reversal. Okay, the market comes lower into that range. Now within this range, so kubanga the same fair value gaps, the dropping up displacement there after taking out that high time frame array, trades back into that imbalance, right? It drops, it breaks the low of that leg that broke that high time frame array. We're expecting ofuna smart money reversal, that leg, you're breaking at that low. So now the idea is now starting to lighten. Kabalo bwatandise okwaka tulaba price eyinza okuba yagala okuba bearish. Okay, we don't just jump in. So the moment we take out that liquidity, or by say liquid or old high, or traded into a PDRA of higher time frame, when we break this low of that leg that took out that array, we could anticipate, or we start to anticipate that this is going to be a long-term high. A long-term high is being created, right? Okay. So immediately any high that trades into a fair value gap or any imbalances, it immediately becomes an intermediate high. So to make it more clear, even if it is a low, so long as it trades back into a BC, it becomes an intermediate low. Any candle that trades into a fair value gap or an imbalance, it immediately becomes an intermediate high. But we have two formation of an intermediate high. We're gonna see that. So price trades back into that range, drops. Now we are seeing that it's now being bearish, right? So we have created a short-term high there. So if this low is lower than that low, that could be called a lower low. In institutional order flow, we call it a short-term low or a swing low. That can make sense. So price trades up again. Now let us say you could anticipate to see price not taking out that short-term high, and this is a lower high, or in basic foundation of price structure, this is a lower high, but first we call it a short-term high. And if it would have like to make trades into an imbalance, just hold it an intermediate high. Like to you, to me, also it an intermediate high or a short-term high, so long as there is an imbalance. So price ne rallying, ne breaking. So breaking, you anticipate to be bearish, right? Okay, that's what's next. Ne money dropping and come out into this range. The trading and come out into this range you're creating. So we're creating at this range. We come out in a range. You're creating a short-term low. Now, check wakati wa short-term low. It is an intermediate low. Yebira wakati wa short-term low ne short-term low. Now here, if you're gonna be bullish and you're not anticipating for market to be bearish, you don't wanna see this intermediate low taken out. This in a short-term low, kuma price ngeri wagulu wayo. Intermediate low is the last joiner. Baso price okudamu nekola intermediate low endala wane eno gifula short-term low ndamu nekola intermediate low endala nekola short-term low endala. So price doesn't have a permanent template. Neither. So okay, wengende eyo bija ku expanding nnyo. Let us stay on what I did here. So etukola short-term low here. Price will come out when range, ne creating that low in a becoming a short-term low. You can do a short-term low. Wakati wa short-term low e bidis in eno wano wabirao intermediate low. You to funyao. So price ate wejja. You can anticipating a price to be bearish. Price wejja ne breaking a short-term low ne intermediate low. That means the bullish idea has been broken. The market won't go to the buy side, or the market won't go in a buy program. It won't move to the higher side. So this being violated, it's showing you weight, and most importantly, what is the narrative you're having, what the bias you're having. Okay, price creates a short-term high, just as we've seen here. Short-term high has been created there. So what chechibeera wakati wa short-term high or short-term low ebi wabirawo intermediate high. So wakati wa short-term high tufuna intermediate high. Now also gamba lwaki tulina intermediate high biri wano. So tugambe this took out that high. So twandigambye nti eno intermediate high because it's higher than the first intermediate high. So I'm gonna use this one because already we are moving at the right side, we're not moving left. So if this is the high that has been created than the first high, I will choose this one. But they are relative. So even if I use this one or use this one, still I'll get the same results. So that's how price needs you to be doing back testing, because it's not always gonna be identical, but this is the structures you can study from. With that said, okay, price drops into the anticipated narrative that we're gonna be bearish. Okay, because the moment it breaks this, it's gonna come back into that range. We're looking for a fair value gap, dropping on lower time frame, looking for entries. Then the market is gonna drop, comes back into the range, that's redistribution. Then it distributes to the discount array. It could be a what? A fair value gap at a discount array, right? It could be a 30-minute array, it could be a 1 hour, it could be a 4 HR discount area. That is a fair value gap. So a fair value gap has a midpoint. A midpoint is called an cross-encroachment, the midpoint there. So you can divide also this half netugifula bukota bubiri then tufuna bukota bubiri, so neba ne part nya. So we wanna see price being reactive onto those points. So we'll come at the open of that, but we are still waiting. We are not taking any longs. So long as we're trading a high time frame, now we're gonna get a smart money reversal. No, we are still gonna wait for something. So okay, price now reacting on the cross encroachment there. Ne come to this range inzo mutadira galamu equilibrium of that range. Ne komao ne kola ne breaking at that low ya hitting first on the array. Ne koma mukano ka range. Ne koma mukano ka range ka high and low. Then ne breaking there. So breaking that high and that high. But chiche tuba tulina wakati wa swing high, wa swing low, ne swing low, or short term low, short term low. Tuba ne intermittent low. So price comes back. We have a low, a high, a lower low, and a higher high. So this becomes a bullish breaker. So price can retest that and then goes higher. So the moment we break this, I'm trusting this as a long-term high, sorry, as a long-term low. So I'm having a long-term high and a long-term low. So this is my dealing range now. I'm gonna aim for these old highs, right? That's why it is, that's why Bagamati market is seeking while yielding liquidity. So it's all seeking a liquidity, I think creating a liquidity. You're gonna see that. Okay, price hitting that break and rallying, comes back into the range there. It could trade back into that range. That could be trapping that the market's gonna move lower, start to rally, start to drop. So if you chase this, it's gonna take you out, right? So we have short-term high. In a short-term high, this becomes what? An intermittent high. So I'm trusting this long-term low. Price comes back to that range, sends it up. Okay, now here we have engineered liquidity. There are relative equal highs. We have this old high. It could be a daily high. It could be a 4-hour high. Price comes back into that range for a short-term discount array, or in a short-term discount array, it could be a fair value gap. So what we have here is an old high, and that is what? That is buy side liquidity. Price is gonna take that out. So when it takes that out, the question mark is it gonna repeat the same thing as it did here? Because that blue line is the same blue line that we have. That's how we got this blue line here, and the same way we are gonna get the same thing. It's gonna repeat just, but you are waiting and see if it's gonna do just as it did here, if it's gonna do the same thing here. If it's gonna continue to the upside, then it will do something. It will do something like this. Let me use a black pen. So you remember we had this short-term low here. So if it's gonna be here and does something like this, it comes down. If it is going to, webangeria kusigala nga yambuka waggulu, eno sigala nga maintains that shouldn't come back to the intermittent low, just as it did here, right? ekomeo, then them pushing it higher, then that's gonna be a continuation. It won't create a smart money reversal of that old high or of that old array jeba targetings over your targetings. So this is how institutional order flow works, because market ekola ebintu bibiri, seekinga liquidity ne creating liquidity. So wano yali nonya liquidity wa discount, naye kati bino byeri kuleka higher highs oba oba highs zino, old highs zino ebere creating liquidity, then later egenda kujja emutwale kati neera ekoze kyekintu kyekimu ere sell lows era ejja kudda ezitwale. So that's how the market moves, taking out liquidity like that. Market feeding up kwekyo. So that's how we can anticipate structure market when we understand the institutional order flow and the PDRAs is better higher time frame, as we're gonna see in episode 6. We're going to talk about liquidity, the PDRAs, and how to use them. So this is the institutional order flow structure. It has a lot of, I would say, zero templates, because also guarantee what if price this isn't a breaking at that high there, netufuna short term low and netufuna swing low or short term low bidi one before matena kuja ku intermediate term low. So this could be a target. So kubanga is then taking that out, still net dropping a lower. That's really possible. So price stay in that template nga eri nchite nti ngeri ikina kuba identical in real market, no, but with experience, that's why I like, or I could recommend for you to do back testing and you journal. That's how you're gonna add up templates and the moment you tell yourself that, or the moment what you can augment, if price does this, I'm doing this, if price does this, I'm stopping. So with experience, you will say, okay, price has created that intermittent high, has broke that short-term high. Okay, my idea isn't fraud. It has just gone back into a short-term premium. Okay, when I say high and low, so this is premium. So this is really discount. So price going back to premium doesn't mean that price has reversed. So you see, that's the understanding that you get when you have experience with backtesting. Go bokoze ne back data go bera ojanulinze into your journal. So that is institutional order flow. The market is going to communicate to you when to wait, when to see that the idea you're having is not there in the marketplace, or switch narrative, or switch anticipation, and you go in the opposite direction. That market won't go there right now, but trust me, it will go there. So okay, I think that has been basic and it has been understandable, just simple, right? So to be brief, an intermittent low has short-term low, even a short-term low BD1 in chechimuna intermittent high, even a short-term high in a short-term and intermittent high, and any candle or any high that trades into a fair value gap, it immediately to a short-term high and short-term high immediately becoming it out intermittent high. So with that said, this is taught in 2022 model ICT, and that is episode 12. So ebanga tusobola kuntegeera, you can go and watch his video. It is also there. So sina kubuzibu kulagira n'okuyanola video ye cause tewabira buzibu bwonna. Okay, let us have something on the charts here. So okay, with the chart here, let us start with the swing high. You can see this. This is a swing high because it has those kind of zemabali at the single one focus swing high. The same with that. Swing high created, swing high broken. Swing high created, swing high broken there. Swing high created, swing high broken. So that is a bullish structure. Now this is a chart. So when you see here that low, we are the where we reversed from, we need to be having a level where price we are reversing the small reversal. The market is not random. Teba we move bang and turn killer to move higher. No, there should be an array taken or traded to for us to get a smart reversal or to get a reversal back to these highs. So we must wait. See that low, it came back in here. Market rallies, broke this. So I'm trusting the fair value gap in here. We're gonna see that in episode 6. So price rallies, come back into this imbalance. You see they are creating higher lows, breaking swing highs. So that is for a buy structure. Then for the sell here, you can see that this is a swing low, a swing low, a swing low. You can see that this is a swing high, a swing high. Swing high is not broken. So price is back into fair value gap, swing low, taken back into a fair value gap there. So this is a sell program. So we don't only look onto the high, the low, no. We look onto the swing, the institutional order flow, market structure. That's really important. Now this is really a nice price run. So it doesn't have that much back and forth price action, but with market with both and like marketing getting more consolidation forth and back, a lot of higher highs created. Now how are you gonna define that? Something like this. So with the institution order flow, you're gonna be understanding that. So in here I created the low here, price runs. This is a BC. Now we're respecting a market net dropping, never took out that low. Market net rallying and breaking at this. Now this can be a swing high. You can also call it an intermittent high because it's trading back in that imbalance. So, but for me, I'll call it a swing high. I won't call it an intermittent high. Depending with me, I'll call it a swing high. So you got that. Price moved up, came back into this fair value gap. They're dropping on powerful SM2 with ES chart to now one in. But we got an SMT, ES is stopping on fair value gap one in. So the market rallies. I'll talk about SMTs, but later in the series, not right now. But we got a bullish SMT where ES never created a lower low and Nasdaq here created a lower low. So that means a bearish. So market rallying, broke a swing high, back into a fair value gap, moved to the upside to there. So I think that's really simple and understandable with institutional order flow. I just need you to do back testing and understand that the market won't be looking the same just as I'm showing, as I'm going and showing you here. So you just need to understand that this is how you learn, but that is not enough. You should go to the charts and see that this is this, that is that. What time did it do this on what I've just discussed here, or on what I've just shared here. I think that's gonna be it for this. So we also had here there should be a time frame array or any array traded to market will just randomly need them program where buy program. So here also traded into fair value gap. You can see respected that we traded till at the open at the close of that candle there, but still stayed in a buy program, never took out that low. We have a swing low here, or a short-term low, and a short-term low here. So this becomes an intermittent low. We want to see price not come to that low. So we can put a few from here to here. We get equilibrium. We want to see price drop to the equilibrium or to the OTE level. We shall also see that later in the series. We trade to the OTE level. We could want to sell that. Then we put a stop loss here. Then price rallies. We could aim for this created high when it is coming to the downside. And this is buy side. This is buy side. Those are the willing buyers at that higher price. So I think now things are being put together and it's really understandable. There's nothing that is confusing. And I think that will be it for this episode. That will be episode 5 part 2, but we're not gonna have it today. So I'm Trace by Ibra, and let us catch back in that episode 2. Thank you all.